Hello again to all the Year 11 students who are following this channel for your coverage. Today, we'll be looking at income accrued under the heading Balance Day Adjustment. Just like the previous two, the objective of this class is to first of all define the term accrued income, show the effect on the timeline, the general journal entries, a neutral balance, profit and loss, and the balance sheet. Our first topic is what is accrued income. Accrued, as we have already seen, in here it would mean revenue accumulated over time but still yet to be invoiced. Accrued income means income due or yet to be received. Therefore, these are income that have been earned during the year but still yet to be received. We can say that the services has been performed, but we still have to receive the income for performing those services. Other terms that are used, we have income due, income receivable, income in arrears, or accrued revenue. Note that income and the word revenue are interchangeable because revenue is considered as our income. So whether we can say accrued income or accrued revenue, it's the same thing. Next is showing income accrued in a timeline. So our famous purple line there, the timeline, the starting and the ending of the accounting period. Now below that we have the blue line representing the amount that we have received. You see it is incomplete, therefore we did not receive the full amount for the year. We have some amount that are still left, which is called income due. All income due at the end of the financial year must be added to the income account to obtain the full value according to the matching concept. Revenue for the accounting period, revenue for that year is matched against the expenses for that year. So we have to bring the income amount to the full value right up to the end of the year by adding the income due. Amount due is regarded as a current asset, so that income due, they are regarded as current asset because it's the amount that's still yet to be received, so we consider that as our asset. It belongs to us, we still have to receive, and it's our current asset. Next topic is to prepare the general journal entries. So the first general journal entries is the debit side, income due account, and the credit is income account. We debit the income due because it's our current asset, and credit income, it's a revenue, and we are going to increase that amount. We add the due to the revenue account, therefore it's going to be on the debit side. The next one is the picture, a summarized version of this topic. We have accrued revenue treated as assets, that is what is owed to the business, and what we earn but still yet to receive. So let us look at the topic in a given example. Let's try and answer the question. As an example, we have a trial balance which shows the interest on deposit we have received $300. On balance day, at the end of the accounting period, interest on deposit due was $30. So those are the two information we have been provided with. Questions? Showing the information in the timeline, determine the general journal entries, effect on the trial balance, profit and loss, and the balance sheet. So the solution to the question given in the previous slide, the first one is to draw the timeline. As we've seen our famous purple line that representing the accounting period, the starting and the ending of the accounting period. Now from that information that we were given, we have been shown that the interest on deposit received during the year as shown in the trial balance was $300. And according to the additional information, income due or interest on deposit due was $30. So we know that the total amount of interest on deposit for the whole year should be $330. So using the timeline, we are able to see how much is due and how much would be the total and what other amounts that we're supposed to be dealing with. So let us look at the second part of the question to prepare the general journal entries. In this case, we're going to debit interest on deposit due because it's a current asset, and credit interest on deposit is a revenue and it will increase. Now in the notes we say that we debit the income due on the accrued income. In this case, the name of our income is interest on deposit. So therefore our accrued income due is interest on deposit due, and we credit the revenue, in this case interest on deposit. Interest in deposit is our revenue account, credit side, and the amount both $30. Next is to prepare the new trial balance. Therefore we debit interest on deposit. We just discussed that it's a current asset. It should appear on the debit side and not on the credit side. So interest on deposit due on the debit side of the trial balance. Whereas in the new trial balance, interest on deposit on the credit side, the new amount will be 330. Where did we get the 330 from? 300 was from the previous balance sheet. And now in this new one, both sides increase by 30. Therefore, it will increase from 300 from the previous one to 330 to the neutral balance. So neutral balance will show interest on deposit on the debit side is interest on deposit due $30. On the credit side, interest on deposit 330, and therefore the trial balance will still balance because both sides have increased by $30. Now on to number 4, preparation of the profit and loss. Note that the profit and loss will have the on the debit side will be having expenses, on the credit side will have the revenue. So only those two, expenses or revenue. In this case, we are dealing with the revenue, income accrued. So it will be on the credit side, the revenue. And the amount will be 330. We have seen it from the trial balance, 330. We get that from the $300 from the previous balance sheet plus the due, which is $30. We come up to 330. So note, profit and loss will either have a revenue or a expenses. As for number 5, the balance sheet will either have a current asset or current liability. Either a current asset or a current liability. In this case, we are having a current asset. Interest on deposit due was our current asset. Therefore, it will have a current asset entry $30. So that is the last part of the question for the exercise in our example. Now for your worksheet. For your worksheet, you have a question there which has got a trial balance, and in the trial balance we have a revenue on the credit side. It's called rent received, $4,000. Additional information you are given there, monthly rent received was $400 per month. You have to calculate the amount that is due. I'll leave that to you, but And you have to show the requirements there. You have to show the timeline, general journal entries, neutral balance, profit and loss, and balance sheet. Just a hint, $400 per month will give you an amount above $4,000. So in that rent receive $4,000, you are receiving $4,000 less than the actual amount you're supposed to receive. So you're supposed to receive an amount more than $4,000. So there are some amount still yet to be received, which is due. And you're going to use this information there, $400 per month, to calculate. You can draw up the timeline 1 year, $4,000, and try to calculate how much is still yet to be received. And I leave that to you for your worksheets. That brings us to the end of our class for this topic, accrued income. Like and subscribe, share it with your friends, those who need to listen to this, year 11 accounting students, for the COVID-19 coverage. Thanks for watching. Hope to see you again. Goodbye.